Welcome to today's lecture. Last time we stopped with a discussion of the Black-Scholes Merton model. I showed you how the derivation of the model works. You start with more or less realistic assumption on the underlying stochastic process for the underlying price. Usually that's the stock price. You then work yourself down up the ladder, better said, with Ito's lemma, and you realize at some point that the price of a derivative, that is a function in the price of the underlying, can also be represented as a stochastic process, as another diffusion process with a slightly different drift and a slightly different diffusion parameter. Then if you have realized this, you construct a portfolio of the underlying and the derivative, and you want to hedge, to delta hedge this portfolio. If the delta hedged portfolio is risk-free, it should yield the risk-free return. This is why the interest rate comes into play in this model. And then by looking at a delta hedged risk-free portfolio, at some point you arrive at the Black-Scholes differential equation. Okay, this doesn't work. Why is it? No, it's working. Okay. And the Black-Scholes differential equation looks like this. We talked about the fact that a differential equation does not yield a real number, but a real valued function as a solution. Usually a differential equation has an infinite number of solutions. As this is the case here, it's a partial stochastic differential equation because it includes stochastic values and random variables as well as partial derivatives. And we need to solve for this partial stochastic differential, stochastic partial differential equation, SPD. And to solve for such a differential equation, you usually require a starting value or a terminal value. And in this case here, we know that although this is the price of the derivative, we know its partial, its terminal value. In case, for example, it's a plain vanilla European call or put, we have the payoff profile in the end. And in case it's a plain vanilla call or plain vanilla put, it's quite simple to solve for the solution of this differential equation. This is the general solution with any payout profile. And in case of a plain vanilla call, it becomes this. And you can solve for this, and this will yield the Black-Scholes Merton pricing formula in case of a plain vanilla European call. You get this slightly different pricing formula for a European put option as well. In some other cases here, this is the put. And in case you have a digital call with a Heaviside function as a payoff profile, then the pricing formula is even simpler. Now, this is the Black-Scholes Merton framework for option pricing. As you can see, one of the nice things about this model is that it actually can be applied to any type of derivative. It's not just that it yields a pricing formula for a European call option and for a European put option. It yields a pricing framework for any type of derivative. The problem now is that in some cases, if the payoff profile is too complex, if it's too complicated, you might not be able to solve for an analytical solution of the differential equation. It simply is the case that sometimes you cannot solve this integral. And you have this in school. You probably have seen this in school as well, that sometimes you are not able to solve for an integral. Hopefully in high school you were always able to do so, but sometimes, well, you cannot find an analytical solution. And the question now is, and this is where we'll start today, what shall we do when you cannot come up with an analytical solution while you can try to solve for it numerically? Meaning that you are not looking for an exact solution, but you are looking for a numerical approximation, a best solution that is close to the exact analytical solution. And we'll first do this by the use of binomial models, then we'll use Monte Carlo simulations and finite differences to get such results. We'll look at this in MATLAB, and you can actually try to solve for this in MATLAB, which is an alternative to R, to Mathematica, and some other mathematical standard programs. If you want to read about this, you can have a look at this book by Paolo Brandi-Marte, Numerical Methods in Finance and Economics. That is already written with MATLAB code. We might have this in the library. I have one upstairs. We'll probably have not too many of those and not too many copies because I think it costs over 108 euros, so it's quite expensive. But it's a very good book. Now, we'll start with binomial lattice processes, and we are doing this in discrete time. The basic idea now is that in the Black-Scholes Merton framework, we're doing it in continuous time. And partly the problems that we are encountering with the Black-Scholes model are due to the fact that we are trying to solve for this in continuous time. So an alternative is just to do it in discrete time. And this is what the binomial and later on trinomial model is all about. The starting point is a financial market on which a stock can be in one of two states. It's a two-state space. And the initial market includes a secure risk-free investment at the time discrete interest rate R. And in addition, we have a stock with an initial value of S. So S is here, and as you can imagine, there are now two possibilities, S goes up or S goes down. This is meant with a two-state space model. So we have SU or SD, U for up, D for down. Very simple. Now first, in such a two-state space model, there's a very simple result how arbitrage-free prices of securities should look like. If you are interested in a derivation of this, have a look at my textbook. There is, I do think in my textbook, yes, there should be a small section in which this arbitrage-free prices are derived. Now, given any financial security with returns C1 and C2 at time 1, the arbitrage-free value of any financial security is given by 1 over 1 plus R, C1 times Q plus C2 times 1 minus Q, with Q being 1 plus R minus D over U minus D. What is this? Is anyone an idea what this is? Yeah? Yeah, risk-neutral pricing. Why is it risk-neutral pricing? What is risk-neutral pricing? Risk-neutral pricing is the basic idea in finance that how would you value any financial contract? You would take the future expected payoffs, and you would need to
minus the risk, which I can take.
Yeah, not minus the risk. What you need to discount the future payoffs to the present day, and this discount factor needs to account for risk, the riskiness of the payouts. So, for example, you are now here, and you have E1, E2, E3. Those are the future payoffs, and you need to discount them with 1 plus R bar, 1 plus R bar squared, and so on. And this interest rate, R bar, should include the risk-free rate, but also any information on the riskiness of these payoffs. And the problem now is that you as an investor have a certain risk aversion. You are risk averse, you're risk neutral, you're risk friendly. So some investors might value risk more or less than other investors. So if you wanted to price a security in this way, each and every investor would have a different discount factor. Now, what can you do instead? You can just argue that prices should not reflect or should not be priced in this way, but they should instead be priced in such a manner that you can just say you have a probability Q and a second probability 1 minus Q, and you assume that a price is equal to the expected value of the payoffs discounted in more or less such a manner that you have. This is a very odd way of writing this. There are better ways to write it. Maybe let's do it this way here. Instead of changing the discount factor for every investor, you do the following. In mathematical finance, you realize that you can actually do it the other way around. You are not taking the interest rates and change it from investor to investor, but you can do the following. You take the expected payoffs, you discount them by the use of the risk-free rate, and you change the probabilities. You change the probabilities in such a way that every price is given by the expected future payoffs discounted with the risk-free rate. And this probability here, or more or less this set of probabilities, and it's called a probability measure, Wahrscheinlichkeitsmaß. Those of you who study financial mathematics or mathematics might know what a probability measure is. These probabilities, these are called risk-neutral probabilities. Why? Because they can be used to assume that each and every investor is risk-neutral. And if an investor is risk-neutral, you are discounting with the risk-free rate. And now you have a difference between the physical probabilities, those you can observe in nature, and if you change them under the assumption that every investor uses the risk-free rate to discount the payments, then you will get the risk-neutral probabilities. They are artificial ones. They cannot be observed in nature, but you have to change and extract them from the pricing structure on the market and the physical probabilities. So Q and 1 minus Q. Given the fact that U and D, those are the physical probabilities. Those you can actually observe in nature. Q and 1 minus Q, those are the risk-neutral probabilities. And in this very simple discrete setting, you can immediately see why this is risk-neutral pricing, because the price is given by 1 over 1 plus R times, what is this? This is simply the expected return under Q, the expected value of under Q of C1, C2, and this is just, well, the discount factor. So the price of the security is given by the discounted expected value under the risk-neutral probabilities. So this is risk-neutral pricing. This is how it's done in mathematical finance all the time, because it is quite elegant and much simpler than trying to come up with the investor-specific discount factor, which is not possible. This is immediately related to a market being complete and arbitrage-free. And it is so central that actually the results are called the fundamental theorem, the first and second fundamental theorem of asset pricing. Does anyone know the fundamental theorems of asset pricing? Anyone? Yeah?
Energy market is arbitrage free if it has at least one
Yeah?
risk
Yeah?
and it's complete.
Yeah.
It exists
The
only.
second one. If there is at least one such probability measure, then it's arbitrage free. And if it's unique, if there is only one probability measure that satisfies this, then it's a complete market. Yeah? So a market, a financial market, being arbitrage free is equivalent to the existence of a risk neutral probability measure. One could be more precise and call it a martingale, but let's not go there. But if we have such probabilities, if there is at least one set of probabilities, then this market is arbitrage free. Okay. Now we want to duplicate this financial security in t equal to 1 with a portfolio consisting of the risk-free investment and the stock. This is the same as in the Albrecht Maurer textbook. Now we start with the risk-free interest rate of 10%. The current stock price is 100, and it can go up and it can go down. And in both scenarios, we'll have a stock price of 125 or 80. And we'll consider a put option with the current underlying price as the strike price. Now, the possible payouts in t equal to 1, they are illustrated in on the following page. You have 125 and 80 here. If the strike is the current stock price, 100, we know that the put is worth 0 in the up state, and it's worth 20 here, meaning that we have a payout of 0 or 20. And we now try to duplicate 0 and 20 by the use of just the underlying and the risk-free rate. Meaning, the duplication portfolio is as follows: 0 and 20 equals 125x or 80x plus 1.1y. X is the number of stocks and y is the number of risk-free bonds, for example, we want to buy. Now, this is very simple. You solve for this linear equation and we get x star is minus 0.44 and so on. And there is one star too much here. And we invest 50.5 into the risk-free rate, meaning we need a short investment in the stock and we need to buy the risk-free bond. This portfolio, obviously, for the market to be arbitrage free, because it generates the same output and the same payments in t equal to 1, it has to have the same price in t equal to 0. So P0 has to be 100 times x star plus y x star, and this is 6.06. And this, in this very simple model, is the the arbitrage-free price of the put option. Is it clear? If the put option pays out 0 or 20, and we duplicate it with a very simple portfolio consisting of the risk-free bond and the stock, the underlying, it's quite simple to calculate the price. Huh? Okay. Why is it so simple? Well, it's just 2 states, 1 period. In contrast to the Black-Scholes model, we only allow to the stock to go up and to go down. We know the states and we know it's just a 1 period model. So by simplifying the model to such an extent, it's quite simple to come up with a price for the option. Okay. Now, these probabilities, they can be interpreted as risk neutral or pseudo risk neutral probabilities, because it follows that 1 over 1 plus r times the expected value of all future payments V1. This should give you the price, the current price of the financial contract. We call Q, or the set Q1 minus Q in this case, the set of probabilities, the risk neutral probability measure. And this is called risk neutral pricing or martingale pricing. And we can also calculate the price of the option via pseudo risk neutral probabilities. Okay. We can quite easily extend this to a multi-period model. Let's take a look at another example. Now, the time evolution of the price now extends over 2 periods. we are given a call option with a term of 2 periods and a strike of 90. At time t equal to 1, the value of the option in t1 can be determined for both SU and SD. And we simply have to recursively use this model, going back one period after another. So what we are doing is, now we've come up with a price for a model that looks like this. Now in a 2-period state, it will look like this. And we can use this here and this to come up with this price. And we can use this and this payout to come up with this price. And then we just use it recursively and go back one period once more and get the option price. This is how you can extend this model from a one period to a multi-period model. Is that clear? I guess this is quite simple. If you do this here, you would get CU and CD, which would be this here, this is CU, and this is CD, equal to 43.18 and 6.056. And you just go back one period, and again one period. However, the payouts can also be duplicated by a portfolio of stocks and the corresponding secure risk-free investment. Then we reapply it, and in this case, in a 2-period model, we get a call price of 28. Okay. Now, next, we want to do it in a risk-neutral approach. For a call option, we know that for the call, it has to apply that in risk-neutral pricing, the call price is given by the discounted expected value of all future payments. Now we know the future payments. This is SU minus the strike and SD minus the strike, and the maximum of it all 0. And we know that we have to discount by the use of the risk-free rate. At any previous point in time t, it's the same, just we need the conditional mean here. For the binomial lattice process, that is this process that it can only go up and down and up and down again, those probabilities, they look like this. We had these risk-neutral probabilities. So again, if you're interested in learning how you can come up with these probabilities, have a look at my textbook. But Q and 1 over Q, no, Q over 1 over Q minus Q, those probabilities are given by these two terms. And now what do we do next? Risk-neutral pricing means we have to calculate the expected value of all future payments and then calculate the expected value with the use of risk-neutral probabilities, Q and 1 minus Q, and discount with the risk-free rate. So let's do this. First of all, we have to see that in this case, because it is a binomial lattice and a binomial lattice process, the probability of the stock price going up J times and going down T minus J times is given by a binomial probability. German Binomialverteilung. So you have to go, you start here, this is S0, and you can go up 2 times and then you go down 1 time, then J is equal to 2 and T minus J is 1, because we have 1, 2, 3 periods. If you go down 1, 2, 3 times, then J is 0 and T minus J is 3, obviously. So this is this probability here. And take a look at it. the stock price at the end is the initial stock price times j times up and t minus j times down. And this is given by a binomial distribution. T over j times q to the jth power times 1 minus q taken to the t minus jth power. So we know the probabilities. So the price of the call should be something like 1 over 1 plus r times C1 up times P up plus C2 down times P D down, in case we only have a one period model, but in this case we have a multi-period model. So we have to take the sum of j starting with 0 up to t. This is the probability. This is P times, and this is the payout, let's call it E. And this here is just the sum of the probability times the payout. And this together should give you the expected value of the payouts. And this, of course, here is the discount factor with the risk-free rate. Is this clear so far? Risk-neutral pricing, you take those probabilities Q and 1 minus Q, more or less Q. As it is a multi-period model, you can go up j times and you can go down t minus j times. Then you get a binomial distribution. And this here, this line here, simply is risk-neutral pricing, meaning that you take the expected value of all future payments under the risk-neutral probability measure and you discount with the use of the risk-free rate. Now, again, let's make it a little more clearer here. The only difference between this and this here is that this is the price of the option in t equal to 0, and this is the price in at any point in time t. And as you can see, slight difference is minus t, minus t, minus t, minus t. And of course here again you have to look at another price. That's the only difference, but we are mostly interested, of course, at this and this. Now, next, we first define A as the largest natural number less than or equal to A dash. Here, and A dash being the logarithm of x over st times d taken to the t minus tth power over the logarithm of u over d. There is a reason why A dash is defined in such a strange way. It is defined in such a strange way as to eliminate the maximum function here. As you can see, there is no maximum function here, and we were able to eliminate this from the formula. And the only difference is that now, if we define A in such a way, this sum now starts at A. Only reason. We want to simplify this expression, and this is why we define A in such a manner. And you can see that now the price of the option, of the call option, is given by 1 over 1 plus r taken to the capital T minus tth power and a sum of weighted payouts. And now let this term be simply the value of a binomial survival function. This is more or less a binomial survival function. Then you can see that if you also substitute q times u over 1 plus r and 1 minus q tilde equal to d over 1 plus r times 1 minus q, you get a general pricing formula for a call option in the binomial model. That is, the price of a call is given by current stock price times a binomial probability minus the strike times 1 plus r taken to the minus capital T minus tth power times again a binomial probability. So ST times a probability minus strike times discount factor times a probability. Does this remind you of something? Any idea? This was the general pricing formula from the Black-Scholes model for a European call option in continuous time. And it's not a big surprise that if you look at the limit of this and you move away from the binomial distribution to the normal distribution and away from discrete discounting to continuous time discounting, you get a formula that is almost equal to this one. And this is no surprise because, well, the Black-Scholes option price formula is the limiting case for n, the number of periods going to infinity. So actually, although one might think that this binomial model is a special case, it's the other way around. The Black-Scholes model is a special case of the binomial model in case you are looking at an infinite number of periods. If you are decreasing the time difference between now and the next point in time. So if you're moving away from discrete time to continuous time, then you can see that actually here the Black-Scholes model is the limiting case. It's a special case of the binomial model. And you can also see that here the relative upward movement is given by this and this. And these are the risk-neutral probabilities. You can also calculate them here. And this is a central result here, that the Black-Scholes model is actually a special case of the binomial lattice process model. Okay. Now, how can we price an option? Quite simply. Remember, we are doing this in risk-neutral pricing. We generalize this formula slightly and look at it in continuous time. Then the price F0 is equal to now a continuous discount factor, exponential function of minus r times delta t times probability times up state plus 1 minus q times down state. And P now is the pseudo-risk-neutral probability exponential function, again, discount factor minus D over U minus D. And again, the variables U and D represent the probabilities for the upper and the lower state of the underlying. Okay. In the limiting case, we get the Black-Scholes model. However, if the differential equation underlying the Black-Scholes model cannot be solved analytically, and this is the case for all those exotic options, we need a discretization strategy. We need to discretize the time, and you can do this, for example, in binomial model, and these are the first two examples. We've seen the first example. Can go up, can go down. What is a trinomial lattice model? You have three potential states.
Stay the same.
Yeah. Can go up, can stay the same, can go down. This is a trinomial lattice model. It's slightly more flexible than a binomial model, and then you can also try Monte Carlo simulation, and you can also try finite difference models. Now, let's first discuss the binomial lattice process and a possible implementation in MATLAB. We've seen that this is theoretically okay. You can show that if you simply add up or if you simply increase the number of discrete points in time you're looking at, then you will get the Black-Scholes model. And for the Black-Scholes model, you know it's analytically correct. It's an arbitrage-free solution for an option price. We've seen this in duplication as well. Now let's try to do this on the computer. We start with S. It can go up once, twice, or thrice. It can go up and down. It will be at S again. And then it can go up and down, and you get these 4 states after 2 periods. No, 3 periods, actually. We now assume that U is equal to 1 over D. This is an assumption we are making. We could have also assumed that it's equally probable. So U equal to 0.5, then D would be equal to 0.5. Now, in this special case, we're assuming U is equal to 1 over D. And we'll see what happens. Now, we try to approximate this geometric Brownian motion for the underlying. In continuous time, we would have ds equal to rs dt plus sigma s dw. So a geometric Brownian motion. Now, in order for the binomial tree to approximate this continuous process, we have to select parameters in such a way that the approximation gets optimal. So the calibration needs to be as good as possible, and the starting point is the price st, or the price after a short period of time, st plus delta t. The log returns, as you might remember, they are the log returns are normally distributed in this case. So ln of st plus delta t over st is distributed according to a normal distribution with r minus sigma squared over 2 delta t as the expected value and sigma squared times delta t as its variance. Now, for the approximation, for the binomial process to be as good as possible, we would expect the log returns to exactly show these parameters on the binomial lattice as well. How shall we do this? So we need the expected value of the returns to be equal to this, and we require that the variance of the relative returns is equal to this. This is true for the continuous process. Now this should be met by the binomial lattice process as well. And since we have 3 degrees of freedom here, and we are only using 2 of them, we can, for example, also set U is equal to 1 over D. We can also choose U is equal to 0.5. Then, of course, D is equal to 0.5 and other choices. But this can be chosen here. This is a modeling choice. Now, for the binomial process, we now get that the expected future price is probability times U times ST plus 1 minus probability times D times ST, current stock price. Yeah, this is again risk-neutral pricing. And in summary, if we know that this here should be equal to this on the binomial lattice, and in the continuous case, ideally we would get this here, we can simply rearrange it, and we see that PUST plus 1 minus P times D times ST should equal exponential function of R times delta T times ST. And again, you will get this. And this is actually how you can come up with this pseudo risk-neutral probability we've seen on a couple of slides before. Now, in order to adjust the variances of the continuous process and its discrete approximation, we have to note that this applies. Variance of the future underlying price is given by this. And then we can substitute this here. For the continuous process, we know this is true. and again set it equal, or this is equal to this here, and then rearrange it, and we get this expression here. You can try it at home, you don't need to memorize it. Just stay with me and see what happens now. Set u equal to 1 over d. Then we get the next line. Obviously, we want to solve for u, so we need to solve for a root or a 0 of u. And it's a quadratic equation, so it's quite simple. U is equal to this here. And again, a Taylor approximation leads to this here. U is equal or approximately equal to the exponential function of sigma times the square root of delta t. Now this is the famous Cox-Ross-Rubinstein model, or Rubinstein model. U is equal to this, then as u is set to 1 over d, you can solve for d. So via this, you get this, and this is the pseudo risk-neutral probability. Now, if we set p is equal to 0, the physical probability of going up is 50% and going down is 50%, we get slightly different pseudo risk-neutral probabilities. Actually, you get u and d here. And this is the Jarrow-Rudd calibration of a binomial lattice process. So the first one is Cox-Ross-Rubinstein, and the second is Jarrow-Rudd. Okay, now let's illustrate it. And you will see it's quite simple in MATLAB, and you simply need the formulas to program it and code it in MATLAB. We're looking at a plain vanilla European call. Starting price is 50, strike is 50, 10% risk-free interest rate, volatility is 40%, and we are looking at it for half a year. Now we assume, and this is important to see, we assume that the correct price, the actual price, is given by the Black-Scholes price. This is an assumption. Normally, we would need to look at the market and take the market price. Now, ideally, under the assumptions of the Black-Scholes model, of course, the market price should be equal to the Black-Scholes price. And it is safely to assume that market prices, even today, will look very closely and very much like the Black-Scholes price. Why? Because all traders are using Black-Scholes. It's not like that the model is perfect and that all assumptions of the Black-Scholes model hold. It's rather that all traders are applying and are using the Black-Scholes model. So for now, we assume the Black-Scholes price is the actual, the true price. Now what happens? If we just insert all these parameters into the Black-Scholes formula, we will get a call price of €6.1165. Now we discretize this in monthly steps. So we take the half a year, and we are not doing it in continuous times, but we are using a binomial model with 6 periods. So it's a discrete model, obviously. We then get delta t is equal to 1 over 12. U, in this particular model, with the Cox-Ross-Rubinstein model, we get u is equal to 1.1224, d is equal to 0.8909, and we get a pseudo risk-neutral probability of 50.73%. What happens now? If you look at it, for the stock price, you get these terminal values. You could also do it by hand. And in the end, you can see those are the possible payouts for the option price. And after a lot of calculations, either by hand or in the computer, you get a price of 6.36. Now, again, you can do it recursively. No? You have the risk-neutral probability. So what you need to do is just take those payouts, let's call it C1, C2, and then calculate P times C1 plus 1 minus P times C2, 1 plus R, discount it, and it should give you this price. And then you can do it recursively, and as you do have the risk-neutral probabilities, the calculation of the option prices is quite simple from now on. You just have to do it from period to period backwards. This is shown here. Now you can do it in continuous time, and you get the prices, for example, 29.77. This is this price here. Okay. Now at time t, we get the price under the Cox-Ross-Rubinstein model, and it's €6.36. Problem now is, as you can see, it is close but not exactly the Black-Scholes price. So 6.36 is not equal to 6.1165. Why? Yeah? Yeah. It's quite simple. If we were to increase the number of steps, we would get closer and closer to the original Black-Scholes price, because as you've seen, the Black-Scholes model is the limiting case for n being the number of steps going to infinity. Okay. Now, let's do it in MATLAB. For the implementation in MATLAB, let Fij be the option price at node ij. So, for example, here, this is 1, 0, 2, 0, 3, 0, and so on. And the variable j designates the event j times delta t, and the variable I is the ith node at the event j. So, okay, not quite. So this is I equal to 1, I equal to 1, I equal to 3, I equal to 4, and this is J1, J2, J1, J2, J3, and so on. And we count from bottom to top. I've done it the wrong way, obviously. Capital N is a number of interval divisions up to the due date t. That is, if we have 1 year and 12 months, this is 1 month, and capital N is 12. The price of the underlying is then given with S, the starting price of the underlying, I times up, and J minus 1 times down. So at maturity, we have Fi, capital N, is the maximum of 0 Su taken to the ith power times d taken to the n minus ith power minus the strike. This is just this here. This is F. Now F. Let me just check that again. Fin. This is F index In. Because we're in the last column, and this is I equal to 1, I guess I equal to 1, I equal to 2, I equal to 3, and so on. And we're moving from bottom to top. Okay. For the previous periods, we know risk-neutral pricing. Take 2 elements, expected value under the risk-neutral probability measure, discounted with a risk-free rate, gives you the payoff 1 period before that. And then, obviously, Fij is equal to this here and this here. Those are the 2 payouts, and expected value and discounted with a risk-free rate. And this is how it looks in MATLAB. Now let's go through this function line by line. In MATLAB, also if you don't want to use MATLAB because you don't have a license, you can use Octave. Octave is the open source variant of MATLAB. In MATLAB, you define a function by writing function. Vectors and matrices are defined by putting them in these brackets here, price, lattice. This is the output. We want the price and the lattice that has been used as the output, and the output is equal to, this is the function name, lattice your call, and the input variables are S0, K, R, T, sigma, and capital N. So we are supplying the function with the starting price of the underlying, the strike K, the risk-free rate R, the time horizon T, the volatility sigma, and the number of steps we want to discretize with capital N. Delta N is obviously delta T is obviously delta T, so T over N. U in this case is exponential function of sigma times square root of delta T. D is defined as 1 over D. P, the risk neutral probability in the Cox-Ross-Rubinstein model was P is equal to exponential function R times delta T minus D over U minus D. And then we have to define the lattice. By the way, in German, lattice is Gitter. Lattice is a Gitter. For I equal to 0 to capital N, we are now initializing the lattice with the different stock prices. Lattice I plus 1, N plus 1 is the maximum of 0, S0 times U, I times up, times D, N minus 1 times down, minus the strike. Actually, this is the lattice of the option prices, of the payouts of the option prices. That clear? And then we take the last column and we go back from the last column and calculate the option prices. So for, we are not going from left to right, but now from right to left. For J equal to N minus 1. So we're starting with the N minus 1th column, and we go back to 0 to the first column, that is C0, in steps of minus 1. So we're counting down from, look at this, this here is the nth column. And we are taking the n minus 1 column, and we are going back minus 1, until we get the 0th column, the last column here. And then what we do is just we take the value of the lattice here is given by the two values in the previous lattice. So lattice I plus 1 is given by lattice I plus 2 and lattice I plus 1 here. Actually here j plus 1, j plus 2, j plus 2. And we're taking these two values times p and 1 minus p discounted with the risk-free rate. This is again risk-neutral pricing. And then we do this from right to left until we get to the very first column, and the price of the option is just the value of the lattice at 0.11, the very first entry in this vector or matrix. So if we do this here, we again do it with the same parameters we used before. If we use 5 steps to discretize this grid, we get 6.3595. If we use 500 steps, we get 6.1140. If we use 1,000, we get 6.1152. Let's have a look. Black-Scholes was 6.1165. So even with 1,000 steps, we are close to the Black-Scholes price, but it's not yet there. Yeah, but you can see that it's moving towards the Black-Scholes price by just increasing the number of steps. Okay. We can do this even graphically. This is just a tiny program that, as you can see, what I'm doing is I'm taking the number of steps and I'm plotting the price of the binomial model in comparison to the Black-Scholes model. And you can see the result on the next slide. This here, this is the Black-Scholes model, this line. And you can see by increasing the number of steps used to discretize the term of the option, the Black-Scholes price stays, of course, at 611.65, but the price we've calculated from the binomial model slowly moves into the direction of the Black-Scholes price. Yeah? So you can see that it converges in a zigzagging course towards the Black-Scholes price. Okay. Now you can improve this. On the one hand, you can see that the probabilities U and D by the discount factor, this can be excluded and done before the program. On the other hand, you can also use this special property of the Cox-Ross-Rubinstein model that actually U times D is equal to 1 or U is equal to 1 over D, that you do not need a matrix to store all this information. You can actually use a vector. Why? Actually, if you have a look at these prices back here, let's have a look at this here. You can see that this price, 50, is the same here and the same here. 56.12 is the same here and here and here. So you have actually 1, 1, 1, 2, 2, 2, 3, 3, 4, 4, 5, 6, 7, 7, 7, 8, 8, 9, 9, 10, 11. So you only need to store a vector with 11 entries because you know the structure of this grid. You know the structure of this lattice. And this is a very odd way of numbering it and indexing it, but a better way, of course, is to do this. 1, 2, 3, 4, 5, and so on. And you see that actually you only need 11 entries in a vector and you don't need a matrix. Okay, so this is a slight variant of the previous program. I called it Smart European Call Lattice. Because in this way, we can pre-compute some invariant quantities. You do not need to calculate those discount factors times p or times 1 minus p all the time. You simply do it before, and then you set up those S values, and you only have one vector and not a matrix. Yeah? Try it in Octave, maybe at home. You can see that it gives you the price of the option as well. It's a little bit faster. Okay. This is a binomial lattice model. The simplest extension is a trinomial model. We are now again looking at the stochastic process of the logarithmic prices, ln of st, and we have 3 states and thus 3 risk-neutral probabilities. P up, P down, and now it stays, so P middle or P medium. We are trying to model this here. So we are again assuming a geometric Brownian motion for the stochastic process underlying the stock price. And we demand that in this case we have the expected value of delta times ln st is equal to this. And we need a requirement on the variance of the process. And we also now require that those 3 probabilities, they add up to 1. Why? Because previously we said 1, p is p, and the second probability is 1 minus p. Then, of course, by definition, the second probability and the first probability, they always add up to 1. But with 3 probabilities, we now want pu plus pm plus pd, that should be equal to 1, so that we can speak of probabilities here. And if this is the case, then you can solve for it. You get 3 equations for pu, pd, and pm. The parameter delta LNS can then be selected, for example, via this. You don't need to memorize it. But in this case, you can do the same in MATLAB again. Just use the formulas, program it, and in case you have a European plain vanilla call, you get these three probabilities here, and it's the same in MATLAB. We have a function that is trying to calculate the option price via a discretization strategy. We need a number of discrete steps we want to divide our time horizon into. We can pre-compute a set of quantities, those three probabilities obviously, and then always those three probabilities times the discount factor. We can do that with this without going into the for loop. And then we set up the S values at maturity. We come up with the lattice and the terminal values, and it's basically the same. Remember that now we have three states, and the lattice will look like this. And it will look slightly different, but the way of computing the option price is the same. You set up the lattice with all those terminal values, and then you take the last column and you go back one column each step and calculate the prices of the option at t minus 1, t minus 2, until you get here, and this is the option price in t equal to 0. In MATLAB, it's a little bit more complicated to program this recursively, but if you do it correctly, it's of course much quicker than doing it by hand. If you now take this to MATLAB, and you have this example, strike price is 100, current stock price 100, risk-free rate is 6%, T is 1 year, sigma is 30%, 3 steps, and delta LNS is 0.2. You can see that if we start with just 3 steps, we get a price of 14.6494. If we use 1,000, then we get 14.05. And actually, if we assume that the true price is given by the Black-Scholes price, in this case would be 14.7171. So it's quite interesting to see that with a trinomial lattice grid, even with just 3 steps, 3 discrete steps, we get a fairly good approximation to the true Black-Scholes price. Obviously, it's a different way of improving this approximation. First idea is to use the binomial model and increase the number of steps forward. The second idea, the second improvement could be not just expect the price to go up or down, but allow the stock price to go up and down and stay at the same level. In this case, the model gets more flexible and we might need slightly less discrete steps than with the binomial model. That is why the price is actually quite good here, even with 3 steps. Okay. This is the trinomial lattice process. You can see it's fairly more complicated, and you get the option price here at the end, or at the start, if you will. Okay. Do you have any questions concerning binomial and trinomial option pricing? Again, if you want to find out more about risk-neutral pricing, pick up a textbook. Doesn't need to be my textbook. Pick up an option pricing textbook, and risk-neutral pricing should be explained in it. You have a question?
If you take more steps, even in a trinomial model, shouldn't it be more accurate than with just 3?
In this case here, it should be. However, it should converge, but I don't think there's a result that it has to improve in every step. So convergence for n to infinity, yes. Improvement in every step to the next step, not necessarily. We are not seeing this here.
So the first value could be a coincidence as well.
Could be a coincidence, but it's, I think, no coincidence that even with 3 steps, it's actually quite good already. Yeah? It's rather surprising that with 1,000 steps, it doesn't get too much better. Yeah? But to be honest, I'm pretty sure there are some results in the literature on the convergence speeds and the convergence behavior of these pricing formulas. But I don't know them right now. What I can say is that whenever you see such a zigzagging, it's never good. I mean, if you have a look at this here, this is never a good sign of a sequence exhibiting such a zigzagging behavior. In optimization, if you ever see such a thing, you would definitely switch models. Because ideally, you would get you want something like this or something like this. But this zigzagging is not a good convergence behavior. Okay. Any other questions concerning the binomial and trinomial models? If not, let's then turn to Monte Carlo simulation. Now, Monte Carlo simulation is, let's start with the basics. Monte Carlo simulation is not restricted to option pricing, but it's a very simple and very general concept in statistics. Does anyone know what Monte Carlo simulation means? Now, the basic idea and the basic onset in statistics is you have a data set and this data sample was observed, and you're assuming that the sample originated from an underlying population with a population distribution that is unknown. Could be a normal distribution, could be a binomial distribution, you don't know. And you're trying to use statistical inference to get an idea, to get an estimate of the true underlying distribution, let's call it x tilde. You want to get an estimate of x based on your sample. Okay. Now, with Monte Carlo simulation, we are more or less going the other way around. We know that we have a distribution x, and x is, for example, distributed according to a normal distribution with 3 and sigma squared equal to 8, with those 2 parameters, and we now want to create a sample that originated exactly under this distribution. Do you have any examples for such a simulation of a sample? Yeah?
You're probably rolling a die.
Yeah. And this is why it's called Monte Carlo simulation. If you go to a roulette table, if you roll a dice, you're doing exactly this. You are simulating observations from a well-known distribution. Because if it's a fair dice, fairer Würfel, and you throw the fair dice, you know that in the population, this is what? What kind of distribution? It's what we call a uniform distribution on the discrete set 1, 2, 3, 4, 5, 6. It's a discrete uniform distribution. Uniform being in German, Gleichverteilung. Yeah? Be careful with the words Gleichverteilung and identische Verteilung. Identical distribution is not a uniform distribution. In English, it's a little bit simpler to differentiate between the two. For example, if y is distributed according to x X and Y are identically distributed. They have identically the same distribution, but they are not uniformly distributed. They are normally distributed. In German we would say, X und Y sind identisch verteilt, aber identisch normal verteilt. Hier, das ist die Gleichverteilung. Ja? Aber im Deutschen ist gleich und identisch verteilt dasselbe. Irgendwie. In German it's the same meaning of the words. Okay. Now with the dice you have a uniform distribution. If you take the continuous version, you could also say that, for example, here you have a uniform distribution on the closed interval from 0 to 1. Or you have a normal distribution. What would a roulette table be? That would also be a uniform distribution on the set of 1, 2, 3 up to, how's it go? 36? Yeah? I'm not quite sure. I don't play roulette. Yeah? Maybe 40. Depends on whether you have a 0 or double 0. And because this idea of generating a sample was first more or less observed centuries ago in gambling, it's called Monte Carlo simulation. And I would assume that for all well-known distributions, normal, Gaussian distribution, uniform, T distribution, Pareto distribution, gamma, beta distribution, all those basic distributions, you not only have a PDF, a CDF, a cumulative distribution function, and a probability density function, but you also have an algorithm with which you can simulate from this particular distribution. Want to see this in action? Yeah. Don't trust me. Let's open R. Okay, what do you want? T or Gaussian? Let's take our norm. How many do you want? 10,000? Let's do 100. Which parameter? Mean equal to 3, SD equal to, let's say, 2.3. There you have it. If you now plot it, let's plot this plot. Density. Looks like a normal distribution, but with 100 values, this is not very good. Those are 10,000. And we get a sample distribution that is close to what we would expect from the normal distribution. And as you can see, it's just with the rolling of the dice. The more times you throw the dice, the more those sample observations will stabilize according to the probabilities of the underlying population distribution. If you throw the dice just once, it might be a 6. Well, I don't have any clue about the distribution. But if you throw the dice 1 million times, you would expect it to be uniformly distributed 1, 2, 3, 4, 5, 6. And this is Monte Carlo simulation. Now, question is, why is it almost always associated with option pricing? It's I would say, the most important application in finance. There are other applications of Monte Carlo simulation in finance, obviously, but option pricing is the most famous one. So let's turn back here. What can we do here? Do you have any idea how we can exploit Monte Carlo simulation for option pricing? Any idea? We can observe today's stock price here. What do you know? Under the assumptions and the prerequisites of the Black-Scholes model. If you go back almost 100 slides, I would guess, you might remember that under a diffusion process or even under a very simple Wiener process, the stock prices and the changes in the stock price, the change in the stochastic process is simply given by what?
Direction and step length.
Yeah, more precisely. We saw that stock prices and log returns are normally and log normally distributed. So what can you do? You can simply simulate the path. Let's assume this is one potential path of this underlying process. What can you do now?
Do it many, many times over.
Okay. This could give you this. And assume you have done this a couple of times. And then what? You know that under the assumption of this process, the underlying has 1, 2, 3, 4, 5 potential outcomes. And then you do what? You want to price an option. So calculate what would the option pay out here. So you would get C1, C2, C3, C4, C5. 5 potential values of the option at maturity. And then?
We should take the sum of the steps.
The sum of the steps?
Yes.
Why?
Because we assume that we assume the normal distribution, and I suppose that we assume the random walk 2.
Yeah.
And that is why I came to the conclusion that we
You
take the sum of the steps.
You can, yeah. You're thinking, you're making it too complicated. In this case, you are already beyond the self-similarity of the random walk, but you have already come up with a potential terminal value of the stock price.
Okay.
You know the terminal value ST. But what do you do? And if you have the terminal price of the stock, S1, S2, S3, and so on, you can just, for example, with a European call, you subtract the strike, take the maximum over this and 0, and you get these are the values CT, the potential values of the option at maturity. But what do you do now to come up with this price? Quite simply, take the average and you discount it. You are simply taking the average, you take the expected value of those potential prices of the option at maturity, you discount it, and then you have an approximation to your option price. Now tell me why, what is the nice thing about this? Why do we need this if we have a Black-Scholes model? And this is why I think you need to understand the basic properties of Black-Scholes to see why in some cases Monte Carlo simulation is needed. For a European call option, this is bogus. For a European call option, you can take Black-Scholes. But when and why do you need Monte Carlo simulation?
Maybe for options that are so complex that you can calculate them properly with Black-Scholes?
Yeah. Every time you don't have an analytical solution to the Black-Scholes differential equation, that is, you don't have a Black-Scholes formula, you do Monte Carlo simulation. Why? What is needed? You simply need to be able to simulate from this process. And this is totally different from the payout profile of the option. This is still a diffusion process even for a very complex Asian option or for any other type of path-dependent option. You need the payout profile, but you know this at the end. You simulate until your computer is burning hot. You put all those simulated paths into the payout profile of the option, and then you can calculate the payout profile, and you only need to take the average and discount it. And we will look at this on the next slide. Now, this, again, I've told you this, Monte Carlo simulation is very simple, but you have a question.
Yeah, how do you know what distribution to take? Is it, are all options distributed normal?
No. No. You have to see those are two totally different questions. What model do you use for your underlying, for your stock price? And what type of option do you have? The solution to the differential equation more or less it is strongly dependent on the question, which type of option do you have? Now look at it this way. For example, if you use a diffusion process and you have a plain vanilla option, then it's solvable. If you have an exotic option, it's not solvable. Now, you can also use a more realistic, what we would refer to as a data generating process, or a diffusion or a stochastic process for the underlying. In that case, again, you have to check how does the Black-Scholes equation look like, and for which options is it solvable or not. So it might be that, for example, here you have a very complex stochastic process, and it might be that for all options it's not solvable. But then in this scenario, your model for the underlying price would even be more complicated. And to be honest, this is where current research in mathematical finance is coming up with even more and more models and newer models. You can only do two things. First of all, you can come up with a stochastic process here that is a little bit more realistic than a simple Wiener process or a diffusion process, because they have been known for 30 years. Or you can see that suddenly on the market there is an even more exotic option now traded, and you try to solve this under a diffusion process or more realistic stochastic process with this new payout profile. So for example, if I now tell you that I am offering an option that looks like this, number of rounds in the soccer World Cup in Germany. Now in this case we just had 1 squared times stock price ST, or 0, and I now take the minimum of this. If this is a new option and I tell you, okay, assume a stochastic process for the stock price and tell me the price of the option. You can see that this weird payout profile will probably make it impossible to get an analytical solution from the Black-Scholes differential equation. But you're still using the same diffusion process as in the Black-Scholes model. Now, if I take a simple plain vanilla call, but I use a path-dependent, a diffusion process with jump diffusion and stochastic jump diffusion and stochastic drift and so on, it might be that I'm not even able to find an analytical solution for a plain vanilla option. But then this is not due to the option being exotic, but the stochastic process for the underlying price being so complicated. So those are the two parameters you can change in the model. Is that clear to everyone? So the more complicated the stochastic process for the stock price, or the more complicated the payout profile of the derivative gets, at some point you will realize that you are no longer able to find an analytical pricing formula. And if this happens, simulate. Okay. One obvious application are so-called path-dependent options. Remember what are path-dependent options? In the simple case of a plain vanilla call, you had a price, look at this way, the stock price goes up, and it now is here. But for pricing, you only need this price. If, for example, the stock price had this evolution, the price of the option would be the same, the payout. But as you might remember, Asian options, for example, they don't pay out the maximum of ST minus K and 0, but they pay out 0 or, for example, the average stock price minus K. And you can see that the average stock price here is obviously smaller than the average stock price here. And for an Asian option, you do not just have to look at the terminal price of the stock, but at the path of the stock price. So this is why it's called a path-dependent option. You could also say that, for example, in some cases you have to take the maximum or the minimum minus the strike. Again, this is a path-dependent option. Why is it more complicated than a plain vanilla option? Because you need to look at all those stock prices at the time evolution of the stock price, and in some cases you don't know when the stock price hits its maximum or minimum value. So this is a path-dependent option, and a simple example is an arithmetic Asian option, and the payout profile is 0 and the average stock price. Take the maximum of those two and you get the payout of the arithmetic Asian option. If it is path dependent, Black-Scholes does not yield an analytical pricing formula. You need Monte Carlo simulation in order to get the price. Okay. Now, because I've already reached my time, what you can do is, please take a look at the path simulation 4 and 5, these two slides here, and you can see how very simply you can simulate from a geometric Brownian motion. Remember, the geometric Brownian motion was the model we assumed throughout our whole discussion of option pricing. And we are starting at 50 now, and you can see 3 simulated paths here of the geometric Brownian motion. It's quite simple. What you do is, remember, the log returns or the prices, they follow a normal or a log normal distribution. So what you do is you take a starting value as 0 and then look at this here, mu dt as sigma dt is just mu sigma square root of dt, and then the next step is just the previous step times t plus sigma dt times a random number of the normal distribution. This is what this is here. And you can see, you can very simply simulate 3 paths out of a geometric Brownian motion, and then pricing is simple as can be. What you will do is here, if you just take a look at this function here, what you do is you simulate a sufficient number of actually here you simulate a sufficient number, and then this is what you're doing. You are discounting in continuous time. Oh no, it's continuous time. Times the payout. And here you insert all your numbers that you've simulated. And this, in the end, gives you the option price. Take a look at it. If you have some time, you can try out the program. Just simply copy and paste it to MATLAB or Octave. You can simulate paths from the geometric Brownian motion. You will get a picture that looks like this. And you can try, then just take all those simulated values and you can start with a plain vanilla European call. It doesn't make too much sense because you could have used Black-Scholes, but you can try to find the difference between the Monte Carlo simulation and the Black-Scholes price. Simulate 10,000, 50,000 paths from this geometric Brownian motion, insert it into the option payout profile, take the average, and then you're done, and discount it. Yeah?
Black-Scholes
indirectly assumes that the returns are normally distributed, but with Monte Carlo, a bit inaccurately, but with Monte Carlo simulation, like I can pick any type of sample and the underlying distribution need not be a normal distribution.
The process, one has to be precise. It's not a distribution, but you're assuming a certain process for the underlying, yes.
Yeah. So if with the Monte Carlo simulation, I could pick like drawings from a distribution with, for example, fatter tails that would actually like more accurate.
Account for tail risk, yeah.
Why would I then even for playing with the option not use the Monte Carlo simulation using a t-distribution, for example?
That is true. That is true. As I've said, there are two ways to arrive at the point that you need Monte Carlo simulation. The first one is that the option itself is too complicated, making it unfeasible to solve for the solution of the Black-Scholes differential equation. The second problem could arise from the stochastic process being so complicated or being in such a mathematical manner that, again, the differential equation cannot be solved. And if, for example, the scenario you've described, that if you want to use a stochastic process that is just more realistic than a normal distribution or a geometric Brownian motion, one that accounts for tail risk, or one that accounts, for example, for jump diffusion or stochastic volatility, then of course it might be that you need Monte Carlo simulation because otherwise the differential equation cannot be solved. That is true, yeah. Okay, any further questions? So if you do not have any questions left, I would say we stop right here and continue our discussion next week. Thank you.